Ladies and gentlemen, welcome to another beautiful Friday because of the SoFi Weekly. Roy, the great and powerful, how you doing?
I am well. How are you?
I'm good. Tevis, the great and powerful, how you doing?
Doing well, man. It's been a big week.
Yes, it has. Yes, it has. Big for you too. You made a pretty compelling video on why you absolutely hate SoFi. Why don't we get into that? No, I'm kidding. But this week was definitely a pivotal week for sentiment. A lot of conversations, a lot of people voiced their opinions. Got a little weird in the retail space. A lot of people opened up. What are your thoughts, Tevis? Help us, to the people that didn't see your video, close out potentially what you were thinking.
I think much of it is a necessary conversation to have. I think there's some takeaways that, just regardless of what the conversation is or is leaning, should be universal. Like, we as shareholders have a responsibility to keep management accountable for the stuff that they put out into the public, and that shouldn't be villainized to some degree. I think how it comes off is also important. Like, I don't want to come off super confrontational or to assume intentions, but at the same time, because like I know that they probably have regulatory constraints for so many things that they just can't comment. But at the same time, it's also naive to think that there isn't a middle ground where small tweaks in terms of how they communicate can go a long way. And so my video that I put out on Wednesday and the conversation subsequent to that, I think from my perspective was just in large degree to bridge the gap between management's viewpoint on things and retail's viewpoint on things. And I think we're fairly in tuned on the retail side. And what we saw this week was, collectively, if we start to hold management more accountable, then there will be a response to that. Now, I don't know necessarily what that response is going to be or what's going to come out of that conversation, but we did get that tweet from Noto, and we saw some fairly negative retail sentiment on Thursday. And a lot of people were like, oh, I'm selling out of my stock because management doesn't communicate. That wasn't really my intention, to bash them or to point that out. Simply to say that, hey, and I told this to Roy. I said, look, I've been covering this company for 4 years, and I've been doing it because I want to basically do it. I'm not compensated by the company in no way, shape, or form. None of us are. And I think that provides a benefit and a drawdown. I think the benefit is that you can sort of speak your mind more freely because I'm not employed by the company. But at the same time, I don't want to light my own reputation and the goodwill that I've built over the years on fire. And so I think that there's a time and a place that you approach those issues and a method by which you approach those issues. But the fact that the conversation needs to be had, I think, is the through line that I want to get across.
Roy, you also had a quite an extensive tweet here about your opinions of the tech platform. Do you have anything you want to add on to what Tevis said?
Elon Musk pays me by character. That's why my tweets are sometimes so long.
Yeah.
That'd be nice. I guess to take a step back, I noticed something in the fourth quarter. Like, it finally clicked. The way that they had displayed, right? That's that slide. Actually, go to that bottom slide. I think it is.
Well, I like the first one that you did. I thought.
Yeah, any of them's fine. But basically, it seemed like in my mind that it wasn't. We talked about the tech platform as far as revenue, as far as it being, a bit of a black box. How central it is to the thesis, AWS, of fintech, all that sort of stuff before. But what I caught in the fourth quarter is it seemed like that the way that they had talked about the platform had shifted. And as I think probably everybody knows in chat, or most people, I'm working on a dissertation, hoping to defend late this year. So it's not anytime soon. The methodology I use it falls under the umbrella of literary criticism. It's rhetorical analysis, and basically, in a nutshell, it's looking at how an argument is formed, the way that you speak, and the way that those words shift depending on authorship, time, context, a lot of different things. So there's a lot of art to it, but there is some science too. And so I was like, okay, it looks like in the slide deck itself, they're seem to be combining in their mind. And I know that they did last year. I remember that they did last year for guidance, the tech platform and the financial services platform. And I was like, okay, that's kind of interesting. Caught that Anthony Noto had referred to these two, lumping them together as if they were one idea. I'm like, I don't think it's always been the case. And so I had a little bit of time, carved out some time, really. I wouldn't say I had extra time. And I'm like, I need to take a look at the last few years of earnings calls. So I pulled up the earnings transcripts. I thought about using an LLM, but they hallucinate. And I was like, okay, that did not work at all. And basically what I was looking for is mentions related to the tech platform. So tech platform, technology platform, Galileo, Technisys, removing anything that analysts, had asked, like because the transcript will pick up if an analyst asks a question about the tech platform, that doesn't count. And what I found was an interesting trend. So part of this is, of course, Galileo and Technisys onboarded. Galileo was acquired in 2020, Technisys in 2022. And so, of course, they're talking a lot more about it initially. But it seemed clear to me that the actual mentions of them have really gone down. So in this case, part of it is they're just talking about the tech platform as a composite instead of individual segments. And so 0 mentions of Technisys and Galileo this quarter. That's fine. There's nothing wrong with any of this. It's just kind of an interesting observance. Even the tech and technology platform, the number of mentions has gone down somewhat, even while that lumping together of tech platform and financial services platform is certainly happening. And increasingly so. It didn't happen until I think mid or late 2023. You can watch my video, read my post. You'll get the idea. But basically, in a nutshell, came to the conclusion that whether it's conscious or subconscious, the way that they think about the tech platform, as far as SoFi, has shifted. And the way you can tell that is the rhetoric has shifted, and compellingly so. What you can't tell is motives. Like, is this done to hide the weakness of the tech platform? Maybe. Is it done simply because, and I think that this is certainly one of the reasons, because that tech platform really does fuel the financial services platform. It's something they've talked about in the past, and they had a really good slide in their earnings that kind of demonstrated how that works. They've talked about it, not so much in earnings, but other demonstrations as well, how that works too. So, or something else, it could be any of those things. And the last little bit too is, human nature tends to talk more often about what we're excited about and what's really going well versus like if something we're not excited about at all, or it's just not working out well. It's human nature to talk about it as little as we can.
Yeah, I think, in earnings calls, they're just talking about what they want to highlight or the things that are doing the best. And obviously the tech platform is not doing its best right now. But I'm curious, do you guys think that this is something that is, because I kind of highlighted this a little bit, that I think it's a market problem, more of the fintech winter conversation rather than Galileo losing market share. Do you think that Galileo is losing market share?
No, I would agree that it's a market problem. I think Anthony Noto in previous fireside chats has commented on the fact that companies need clarity from the Fed on how many rates they're going to have to determine what the spend is going to be, or at least if they're going to be conservative or aggressive. And then I think with regards to Roy's thing, like the first order effect or the first order conclusion that you would come to is that management is not as excited about the tech platform, and as a result, they're not mentioning it more, and that correlates with the low growth in the tech platform. I would actually go one level deeper into that and say it's not necessarily due to correlation, it's more so causation, in the sense that management knows that their audience is the wider market. And so if the tech platform has slowed due to macro reasons, management doesn't want to beat that horse to death by still talking about the tech platform over and over again if the growth rate is not there, because the market will gloss over it entirely. And as a result of the growth rate, has management's sentiment changed? Not necessarily as a result of management's interest has the growth rate changed, if that makes sense. Only to say that they're accounting for this other variable, which is the audience. And the audience cares about high growth. The audience cares about innovative products. The audience cares about, what is the exciting new product line. And for as long as tech is that, management is going to talk about it. And the moment that tech is not that, management is not going to talk about it. And I think that's what you saw in Roy's post, or at least that's how I interpreted it.
I think that we should highlight this as well. It's from Scott Henderson, an employee at Galileo. Don't lose sight of the long-term vision. We're just coming out of a fintech winter. Big deals take time. Galileo announced signing 3 new large deals.
Yeah, I really like that metaphor. In the winter, a lot of plants are just in survival mode and try to go dormant, and a lot will just die. They're perennials, not perennials, annuals, and so that's the reality with a lot of fintechs is that they're not looking to do anything but survive. Now, that's not the case with all of them. If they're an incredible company like Robinhood, they're going to outperform. But a lot of them are just like happy to survive and make it to the next season. The other thing that happens too is there's not a lot of new growth, and that's I think even the better part of the metaphor is where are all the fintech startups? Where are all the fintech IPOs? Well, they've almost completely just not existed, and that really hurts the tech platform when you're basically building this for fintechs. And also the way there's more in the video and stuff, but you're also trying to capture the legacy industry as well on the financial side. But man, if it's just winter for a really long time, there's no plans coming up, new shoots of fintech, who are you going to sell to? Everybody's in survival mode. So I think the macro has shifted. It is fintech spring. I mean, the employee said as much. I've seen multiple companies say the same thing. They know there's a lot of excitement coming, and my concern is, and I made a couple of videos on this too, is like there's been a couple of macro shifts that really, really favor Galileo, but we've not seen acceleration. I didn't think that we would, this quarter. I had pretty low numbers, and they managed to even come short of those somehow. But in a seasonally strong quarter, like quarter one is when it's supposed to be weak. But the guidance is so weak, and they're usually pretty accurate on guidance on the technology platform. I don't think it's being overly conservative. Maybe it is, time will tell. But that has me thinking, okay, maybe it's not just macro. That's been a big factor, though. It's significant. And we can't just say, oh, it's just because SoFi sucks. That's not true.
Yeah. I think that it's important for people to highlight, or that it is important to highlight on the tech platform, that they went into big banks or away from fintech into larger financial institutions, not because out of like a growing total addressable market, but more out of survivability. I think it was one of those things where a company had to adapt because the old pond that they were in completely dried up. The hope is that is returning. And, that has been highlighted from a bunch of people in the market that it is returning. The optimism in fintech is returning. So I think some people have just completely written off the tech platform. I think it'll be an amazing asset for SoFi going forward. And it's paid for, so whether or not it was a good return on invested capital before, too late for that. That's done.
Sorry, please explain the it's paid for comment.
We paid the $2 billion.
Yeah, but it hasn't earned out that $2 billion.
I know, but we can't go back in time to the time to sell or make a decision based on the performance of the tech platform was at the time that they.
But that's not a way to judge it. It's not a way to judge it, though. It's like I go to the roulette table and I drop 50 grand and I say it's going to be red and it hits on black and I say, oh well, it's done, decision's over. Like it doesn't mean it's a good decision or that it if the tech platform earned out or had a path to earning out that purchase, like Facebook bought Instagram for $1 billion. Now Instagram does like $1 billion every quarter or whatever. That's an amazing purchase. I can't say that about the tech platform. I don't know when the tech platform is going to earn out. It's going to be a long period of time. And I guess my question based on that is like, what makes you confident that that was a good purchase? Because
but it's written off though. Like what I'm saying is no one's giving the tech platform a premium. So
bro, who cares that it's written off? That's like a paper accounting thing. I'm talking about in reality.
I don't know what you mean.
Like you can write off a huge purchase that doesn't help your business grow and charge it off as goodwill. And then
I don't mean actually written off. I mean Wall Street is not pricing into their future performance. Like I don't mean goodwill written off. I mean,
but that's not a good thing either. Like if Wall Street is writing it off, then you're moving backwards in time towards getting that hybrid multiple. Like you're not doing yourself any favors. You don't want Wall Street to write it off. That's the whole name of the game.
Not if I bought previously, but if I'm buying now, I want to buy whenever sentiment's bottomed out.
Yeah, I mean that ship is already sold as a thing, and
yeah, that's all I'm saying.
2020 and 2022, early 2022, every acquisition, maybe not every, 95% of acquisitions done in that time frame were overvalued. At least we don't have like live on go acquisition, which is grossly overvalued. It was the season, it's better than honey for PayPal. That wasn't even during the COVID era.
But sorry, Tevis, if you're going to say something, but I think that we should transition to some.
Just one thing really quick. Like, I think this is really a matter of everybody perceiving it differently based on whatever their KPIs are or what they deem to be important. Because if you're strictly looking at Technisys and Galileo as a black and white thing that has to earn out the ROI of what we paid in a certain period of time, then this is probably not the most successful acquisition. But if you're looking at it to say, it doesn't really matter what we paid, and it doesn't really matter if it doesn't, make any money for the next 10 years, because it's going to be a key strategic acquisition in terms of our flywheel and our competitive advantage, then sure, it was a successful acquisition. My point is that like, I think management needs to have more clarity, and just going back to what we were saying in the beginning, around how they're really looking at Galileo and Technisys to say, well, guys, we are viewing this on the management team as a sunk cost for the next 5 years because it's going to build an impenetrable moat beyond that when we aggregate everything together. Then investors can baseline to say, oh, okay, this is how management is seeing it. So we shouldn't really be focused on the line item or the revenue growth for Technisys because it's a strategic asset play. So that's all I'm saying, is that ambiguity out there leaves it open to interpretation for investors to judge whether it was successful or not, when we don't really know management's long-term intentions and how that counteracts the short-term ROI of the opportunity cost for that money.
Yeah. Going on, let's talk a little bit about SoFi in 2025. Because so far everything that we've said has been how they've performed in these markets. I think a lot of people are changing their mind on the sentiment of the company, and I talked to Tevis about this in DMs earlier today, or maybe we were talking, but anyway, the idea was that before I used to get really excited about the longer term future for SoFi. Things are going to get good 12 months from now. Things are going to get good on the back half of this year. But it feels like I'm very excited for Q1. What do you guys think about what's happened this week? We've seen multiple companies get forward flow agreements. I think Pagaya got 2 separate agreements this week. They got I think a $500 million ABS deal and then a forward flow agreement for like $2.4 billion from Blue Owl Capital.
Yep. PayPal even got an extension on that KKR deal with buy now, pay later. Like it's the season we're in. There's a tremendous appetite for not even like premium loans and premium scores a premium product is what I'm saying with what SoFi is offering. So like this is okay. let me take one step back. If the loan platform did not exist at all, I'd be like, this really sucks. I probably wouldn't sell. I might have sold some. I don't know. It'd be very, very different. But the loan platform, it's not just like shifting and like, well, tech platform didn't work out. I guess loan platform is what we're relying on. The loan platform is so amazing, exciting, and it aligns perfectly well with not just a premium product where it seems like they have an edge, but also the macro is hitting it just right. When that tends to happen, good things happen. And we've seen that as far as the way that others have treated the loan platform itself, and also what competitors, not exactly competitors, but peers are able to offer as far as their similar products.
Tevis, anything on Q1 or forward flow deals that get you excited, or potentially are you a little bit on the market side of, hey, things might not be as good and the tech platform issues are enough to potentially bring the valuation down?
I think the longer that I sit with the numbers, the more time I have to digest and set proper expectations on what those results could potentially end up being. So what does that mean, Tevis? That means that the business has told us that they want to invest more into the growth and less into the profitability. So let less trickle down to the bottom line. So I have to adjust my EPS expectations down, but then there's also some positive things that are associated with that. For example, web traffic came in really, really strong, and we saw that today. I think that them reinvesting strongly into the business will mean more initiatives. I think that will mean a stronger member growth overall. Like, I think member growth is going to come in way higher than our expectations because they're actually reinvesting back into those line items, right? And so it really, if you look at SoFi as a combined view of 20 of their main metrics, half of their metrics are going to be less than we expected, and half of their metrics are going to be more than we expected based on them reinvesting into growth and not into profitability. Like expenses might go up, for example, right? And like one of the things that I look at in all of my earnings breakdown videos is I look at that operating leverage. I look at the ratio between the revenue increase versus the expenses increase. And I say, wow, this business is becoming more efficient. But for Q1, for example, we could see expenses increasing at the same rate or even higher than revenue. Why? Because they really want to accelerate that for future quarters down the line. And so that's an example of what I mean by we have to look at different metrics and adjust our expectations accordingly.
Yeah. But I'm curious, at the stage of SoFi's growth, where do you want them? Because whenever I initially set my EPS targets, and then whenever I saw it, I was like, oh, that's not exciting. You know, I wanted more than that. I at least wanted 30 cents. And that's from where like they are setting the bar. So I know that they're going to come above 30 cents, or at least I'm very confident on that assumption. But you know, where do they place that? The interesting thing is, though, and I was actually getting pretty like put down by this idea of like, okay, well, SoFi might lose a bit of their edge because of these 2026 you know, price targets that they want to get to for management to end up, you know, cashing in big, that they might end up full steaming ahead profitability, not worrying about growth, and potentially losing that sight of a company that they're building for decades rather than quarters. And I like to buy companies that focus on the really long term. You know, if you look at Robinhood, if you look at Nubank, if you look at all those businesses in fintech, they say, hey, you know what? We're actually focused on growth right now. The profitability will come. And so the fact that SoFi actually put that out actually makes me feel like they're a younger company than, or you know, more innovative than, you know, maybe people were giving them credit for. Whenever Wall Street is allowed to just say, oh, this is what they're projecting for EPS, so then we can treat it like a normal company, you can never give it that unicorn level premium that is more of a story stock premium. So I'm actually liking this a lot more, but we have to see it through the numbers. Q1 might actually beat expectations on EPS and growth.
Yeah, I can jump in, and then I'd love to hear Roy's thoughts on it as well. I think that traditionally, I've always been growth over profitability type of person. Reinvest all your profit back into the business to grow faster.
100%.
But that is a very tech-oriented mindset. Like that comes from software, and that comes from, that Amazon style of like Amazon was a huge company and they still weren't making a profit on purpose so as to avoid taxes and so as to grow faster than competitors and capture more market share.
Your margin is my opportunity, right?
Exactly.
Yeah.
The difference is SoFi is a bank, and SoFi is viewed by traditional banking analysts. And traditional banking analysts have different criteria that they judge the success or failure of any of the stocks that they're covering. And so if SoFi were to grow, 40% instead of 30%, what is the incremental lift that analyst would give it versus if they have 5 cents more EPS than analysts were expecting? So that same dollar amount, if it's invested into higher growth versus if it's trickled down to the bottom line, what does that traditional analyst value more? And I think in that context, it's important because I genuinely am starting to believe, and this might just be me, but I'm genuinely starting to believe that management doesn't really care about the 2026 PSUs because I think it's going to be very easy for them to renegotiate those PSUs to like 2028 or 2030. And like they're going to get that money eventually. They don't necessarily need to get it in 2026. And so they're not in such a rush and they're building this for the long term. We externally, since we've had no indication, automatically assume, because we're all poors, we automatically assume that if Noto has $400 million, that's the main thing that he wakes up in the morning and goes to sleep at night thinking about. But reality, he's probably thinking about the business at a much deeper level than that. And as a result of that, maybe he's willing to have short-term pain for long-term gain in the form of future profitability versus growth today. And so I understand, like if I'm trying to steel man the argument, I would say, okay, I understand where Noto is coming from, but I only understand that if they're not tracking for the PSUs in 2026. Because if they were, I would say, well, traditional bank analysts care more about profitability. So let's just squeeze the juice out of it, get the highest EPS possible, get those PSUs. And then in 2026, after you unlock the PSUs, then we can say, hey, we're going back to the growth, guys. And so like that's where my head is at right now.
Roy?
Yeah, I agree mostly. I agree with everything you said, Tevis. I think the only thing that I'd like to add is agreeing with what you said. I don't think it was communicated very well at all. Like that should have come out in the call or in the slides and been made clear instead of afterwards relying on an interview that not everybody's going to see immediately, especially people that are looking and saying, that's really what they're guiding. Why am I holding this company? And they sell it. Don't do that. Just, put it out there in the front end and just say, hey, we're being more conservative than you might expect for guidance simply because we're building for the long-term future. And we see an opportunity here to really accelerate that growth. You won't see that immediately. There is an expense to that. That's great. That's enough. More detail is great too, but I mean, that's better than what they gave us initially. Now, he did a great job. Was it in the Bloomberg interview? I don't remember which of the two interviews. There were two interviews, right? I'm not making that up.
Yep, CNBC and Bloomberg.
These 2 weeks have felt like 2 months. But great level of detail there. I just wish they had a little touch on that in the actual call itself, so people would be like, "Oh, okay, well, they're doing something with it. It's not just SoFi being SoFi."
I think this is sort of going back to PayPal, and I just sold PayPal, by the way. And since I've sold PayPal, there's been a bunch of information that has come out and talked about, oh wow, actually they did all these things. This is really bullish. This is really bullish. They didn't cover this. And it is a serious problem. You just had a shareholder that sold, and what really went wrong was a massive lack of good communication. And so I think there are CEOs that can literally have not great quarters and pull a miracle out of it, like Tesla, where they keep you focused on the aspects that people should be focused on. Okay. And You can have absolutely amazing execution like SoFi does, and still lack other areas like communication, where potentially they lose some points on those earnings calls. Because you're right, we didn't even realize that their new objective in 2025 was full growth, like not growth at all costs, but very focused, until we saw that CNBC interview, which is
Yeah.
viewed by way less people, or the amount of people that are watching it are not the actual core SoFi audience.
Yeah. How I put it in my video was, it really honestly seems that there's this mega spotlight put on one or two core initiatives that management is focusing on. And whenever management changes the spotlight from one thing to another, it sort of catches retail blindsided, because we're not privy to all of the hundreds of hours of conversation and rumination internally around them debating if they should or should not change that spotlight. We're only privy to the decision after the fact, as a result of some interview that's dropped on after the earnings. So loan platform business, I think, is the latest one. Crypto is probably one as well for 2025. The thing that I would like more for communication, and I want to open the floor on this topic because I think it's an important one. The thing that I would like more is that whenever they change the spotlight from one thing to another, to provide a little bit of color as to what went into that decision-making process. What were the inputs that contributed to them changing that? Hey, we're still bullish on level one options, but we think that focusing on the loan platform business first will actually make more money for the business. And it's probably going to lead us to make, 10 cents more in EPS over the next 2 years versus just rolling out level one options. This is from our own internal, surveying and studies. That's why we made that decision. Like something as simple as like, hey, 2 sentences would go a really long way, so that retail is along with management around why these decisions are made. And we don't just blindly trust management to make the best decision at all times, when, that's what we're doing right now. What I wanted to open the floor to was, we know that SoFi, that Noto, the CEO, is going to have a fireside chat on Tuesday. I'm going to be live streaming it. Tanner, I think, are you going to be live streaming it? And we're going to be live streaming that event. At least at minimum, one of us will be on Tuesday. As representatives of the retail analyst community, Tanner, what would be some questions that you would want to ask management? And I'm actually working on a full video for this, just questions that I've been thinking through over the past couple of days, but I'm curious to hear from you guys.
Go ahead, Roy.
Yeah. Tevis and I discussed this before, but I trying to think of actual questions that they would be able to answer, that they'd want to answer. I guess the biggest thing for me is, especially with the research that I've done over the last couple of days, are they as a business? This is more just to figure out if it's conscious or subconscious. Are they as a business thinking about the platform, in a tech platform, in any different way than they were initially than when that acquisition was landed? I'm curious if they see it more now as like, hey, this is great for our internal cost control and development, more so than a real driver of the future. He continues to mention AWS of fintech, and it's not really a question, but more of a comment. Like that metaphor, I don't think retail largely understood. I think some people were thinking like this means that this is the TAM of this industry, and that's just not the case. But instead, it's more of a metaphor of like what the tech platform actually enables. So it's a comment, not a question. But I'm like, man, give us a different metaphor. Clarify that a little bit too. Noted us things. I noticed too with these the 13 earnings transcripts that I went through. He'll repeat key phrases oftentimes, and that's really valuable. But it actually does the opposite when it's like totally misunderstood by the audience. And when you're communicating in his role, even though it's like, yes, people should understand it's AWS of fintech does not mean the TAM. But it's still important for him to make sure that what he is saying, the message he's trying to send out there, is understood in the way that he was hoping it to. And if not, back away. Clearly that didn't work and use something else. So that's not a question though. It's just an observation.
Yeah, I think there's been a lot of conversation around whether SoFi needs an investor day or not. But in my opinion, I feel like I know a lot about Robinhood. I knew a lot about Robinhood going into their investor day, and I knew a heck of a lot more whenever I left it. Not only to just know more about the industries that they're in, but also how they think about the industries that they're in. I think that that's very important. So potentially looking at Robinhood's crypto platform, you could think that it's very small. The fact that they dedicated almost like 1/3 of their presentation to crypto makes you realize that this could potentially be more of a crypto company than a side project that might be included on SoFi Invest or something like this. Like they want to have all pieces of it. And now, just recently, Anthony Noto has brought up, the different types of products that he would want in crypto, but maybe there are different types of lending products or different types of brokerage products that they would want to get into. There was a slide in Robinhood's Investor Day where they talked about going global. Well, is this their type of ambition for Galileo? If they say something along the lines of, we are in LATAM, or well, all the Americas, but there's actually a 10x potential globally. Well, then this actually gives you their idea that they are thinking about that sort of thing, or potential dates of when they're going to get into those areas. Like Robinhood hasn't announced that they're going into Asia, but they have, or Singapore before that day, but they announced that they're going into Asia in 2025. So it gives people timelines. It allows for future multiples, because people get to, not only think about where the company is, but where it could potentially be going, and help them. Like, I don't know. I'm just a big proponent of more transparency is better for every investor. Whether you decide with that transparency that you're going to sell, that's better for the investor, or if you want to double down.
And I think maybe 3 quarters ago, Noto mentioned intentionally not releasing certain products just because the macro environment wasn't there. I mean, like I just pulled it up, the earnings transcript. He said, even with how great 2024 was, the future has never been brighter for SoFi than it is with 2025. The operating environment is the strongest it's been. So I'm curious, does this mean, given this operating environment, that we should expect to see a return to that flurry of product launches like they had, really when they first acquired Galileo, and then after that, Technisys? They were shipping a lot of products, and that's really, really slowed down. It's not that they're doing nothing, but I'm also curious if like a lot of these are pre-built and basically just ready to go for the right time, and how that looks like for the future. Or are we not expecting that was just a kind of a blip, just simply because they brought on Galileo and Technisys, and they could do it then, and they can't really do that now?
There's still a lot of products that Galileo offers that are not offered through SoFi. And I think probably the most addressable one is secured cards. But like, where are you with that? Are you even remotely thinking of that? Is there a reason why you potentially want to refer out secured cards to Chime? Because that's literally what they're doing, versus offering your own secured cards. So I think clearing up a lot of those answers can make people understand the business more. Showing demographics of your customers. Obviously, we get a lot of that information, but
In related to products, it's the one that we talk about probably the most, just because we're very aware of it as investors, is level one options. And not so much like, okay, where are we with level one options, but how do they prioritize what products to release and whatnot? Like, are they like very limited as far as like, okay, we can focus just on, like really one big project and a couple of smaller projects at one time, but these are on the map? Or like, how does that work? We have no idea.
yeah, like I'll show you a slide here really quickly. Even simple slides like this would be amazing to see from SoFi. What is the type of client that's actually coming onto the platform? Because they recently just increased their FDIC to $3 million, and I can pull a narrative from that decision. But to lay that out to their investor base would do a lot more than the stock than just changing their FDIC from 2 million to 3 million. to say that the largest or the fastest, segment in their audience is people with $2 million plus coming onto the platform is a really bullish statement to make.
Yeah.
So
I also with regards to that Robinhood chart, I also had the cohort breakdown, the segment breakdown of Galileo accounts as one of my wish list items for management more communication, mostly because I wanted to see whether they were diversifying out of fintech and traditional banks to non-banking segments. Like they talked about the major hotel rewards provider, and I want to know whether that's a strategy that they're consciously going after, or whether that's something reactive that they're still targeting fintechs and traditional financial institutions. And then if they get something out of that vertical, then that's great. They'll entertain it. Or whether they're just going, like, whether they're going wide or whether they're going super deep into that banking vertical specifically.
you guys think I can't read your chat? I can read all the chats.
He sees all.
Now, what's it called? That is another thing too. Like whenever SoFi whenever SoFi said on their most recent earnings call, they said, hey, we just got a new customer that is a top 10 customer for us. Okay. How do we know how big that is? And I think that it's important that a lot of companies in software say, oh, these are the different cohorts of 2 million plus, 5 million plus, under $1 million. Is this annual reoccurring revenue? Is this direct from the charges and the new accounts that they're opening, and they're charged on a direct basis based on usage? We don't know a lot. And everyone wants to keep screaming regulation. That is absolute bullshit. There's no regulation absolutely on saying whether or not that they make annual reoccurring revenue versus usage-based revenue. Okay.
I'd also like to know if there's a flywheel at all that's been happening with Galileo. For instance, do they have somebody on board for their debit card processing, and then they say, oh yeah, like we see the rate of adoption for new Galileo products at an average of whatever, or maybe there is no adoption, maybe there is no flywheel. We don't know. If there is one, it's not working too well, but any level of detail there.
Yeah. We very much understand the flywheel for the bank side.
Yes, and it's working well.
Yeah. Okay, what else do you guys want to cover on the SoFi Weekly? We've lost Tevis.
I'm still here, man. I'm absolutely still. The chat is on fire tonight, and I absolutely love it.
Highlight Nala's thing there.
Nala bought Tevis, I think, one Joby share, but he's not even going to buy Joby with that $10. So
yeah,
that one comes.
Nala just funded my Super Bowl bet for this Sunday, so thanks for encouraging my degeneracy, Nala.
Did we? I know you showed the graphic, but did we talk about the website traffic at all for SoFi?
Massive uptake. Going from 16.5 million to 19.4 million. It was, out of every stock that I cover, the largest increase month over month. And SoFi also benefits from holiday spend and stuff like this. Obviously, you can give some slack to the Affirms and PayPals of the world that degrade there. But SoFi did absolutely amazing. I can only attribute that to one thing, and that's TGL. What were your guys' thoughts?
Yeah, I think you're right. If it wasn't for the LA fires, maybe you could be like, well, some of that's SoFi Stadium, but yeah, I think that's the only explanation, really. And it makes a little bit more sense whenever we see them cut rates kind of preemptively without there being any tangible reason for it. It's great for margins, but it usually indicates, at least to me, and I think to all of us, is like, hey, they're probably doing pretty well as far as their goals, hitting the membership marks.
Tevis, what did you think about website traffic? And do you think TGL is working? And by working, I don't mean that it's not bringing on new customers, because obviously it's going to be bringing on new customers. It's whether or not the amount that they paid for it is going to bring in enough customers.
Yeah, I mean, I think same argument, right? And like, I really hate to get esoteric here and like answer with a non-answer, but I do think it is the exact same argument around Galileo. Like, is Galileo working? It really depends on what their goal is, right? In terms of the TGL, like, how do they quantify the return on investment for TGL? Is it a very quantifiable thing in the first place? Like, hey, you have, like, for example, you have a referral code, and based on that referral code, we can attribute how many people we got from that funnel, and then we can divide that all out to determine the customer acquisition cost and how effective that funnel is relative to other funnels. That's a very quantifiable way that you can do it. Or you can do it more qualitatively to say, this increases our brand awareness, and in 5 years, people will know the name SoFi, and a part of that is through TGL. So I don't know how management is looking through their marketing efforts. I don't know how it is for SoFi Stadium. I don't know how it is for TGL, whether they're looking for a direct return or whether they're looking for a holistic return over a longer period of time. But I think TGL is working in the sense that it is creating buzz, it's creating eyeballs, it's creating content online, it's creating clips, it's creating conversation. I don't know how well it's working in terms of direct conversion, because I don't know that that's their primary KPI that they're tracking for it.
I do think that they're just trying to gauge brand awareness. But that being said, I actually do think I'm on the side now that TGL is a massive failure. I think that it'll go down as just a train wreck. And
very strong words.
Oh, dude, I've got a clip ready. Can I show you this?
Yeah, please explain. Oh, the machine thing? Yeah.
This is great. Remember, now I don't know this person exactly. Tommy Fleetwood, I'm going to assume that this is who this is. He is a professional golfer, one of the best in the world. He makes an unbelievable amount of money to do this full time. Let's go ahead and watch him play at what he thinks is a serious game. Strikes through before the screen registers. He's very confident. Okay. There's no upset. He's not throwing his club. He's still very confident in his shot. Remember, at this level of golf, they are focused on the spin of the ball. He knows exactly where he hit it on the club. These guys are the best of the best in the entire world. And then he sees what happens, and the ball goes flat. And he laughs about it. That is not what happened. The whole crowd boos, because they're playing music, I won't play it. The whole crowd boos. They all know that is not what just happened. And you're going to put trophies on this, money, tournaments. It's a joke. People are going to laugh about this. And so, yes, this is the simulated cameras are the problem. And they could switch it out. And by the way, from what I heard, the video that I watched, the little research video of the My Golf Spy, the guy that actually broke this down, the camera system that they're using to determine the ball's trajectory is not even a top 5 system, not a top 5 one. And they could have spent a lot of money to make this perfect, and it would have been very accurate. But they went with a company called Full Swing. And the reason why they did that is because Tiger Woods has a direct partnership with that business. Okay. And Tiger Woods has a very, very close connection with Tomorrow Sports. So I don't know how they get away from this problem. So I don't know if this is just going to be a very systemic problem that ends up not getting fixed, or if they can even fix it mid-season. But you're already seeing the average view counts for TGL falling off a cliff.
So is there any direct proof out there that they went with it because of the Tiger connection, or is that just like an assumption?
That's my assumption.
Right.
No definitive proof, but he does have a partnership with Full Swing. That is proven. He does have an ownership stake in Tomorrow Sports, which does this. And the worst part is that there is a system that would do this perfectly. That does cost a lot more. I think they're like $20,000 per unit, but that's nothing in the grand scheme of the expenses of SoFi Center. Roy?
Yeah, I mean, we've talked about it before, but I don't think that SoFi spent an arm and a leg on the partnership. The branding and everything looks nice. I think it'll do what they need as far as the awareness. It'd be nice if it really took off, but if it doesn't, it's not the end of the world. It's probably more than they spent on WNBA, but not
They
like
didn't buy
SoFi's doing.
WM. They bought the NBA. You're thinking of Robinhood.
I think
You're
I
right.
think you're thinking about it the wrong way, Roy. Like they built out the stadium for that. They're associating their brand to this. If this is a train wreck, the first thing that people are going to say is like, "Oh, who's behind this?" SoFi.
I will say it's a little ironic if technology is what fells TGL and
It's the whole thing.
the tech platform is kind of lackluster.
No, the WNBA was from Robinhood. Roy
Yeah,
has a good stake in that company, but we did the banking partnership for the NBA. I actually think that this is going to be a lot of money. Just the entire naming rights, the center, the amount that management and everyone at SoFi are retweeting TGL. I think that they actually have a lot riding on TGL.
Well, that's not good if that's the case.
And it could be very cool. I think a lot of people are very interested in it, but things like that will make people not want to return back. Sorry to Tommy Fleetwood for that experience. All right. Anything else that we want to cover in the last little bit? Or do we want to jump over to potentially extra long conversation on other potential names? Because boy, oh boy, do I want to talk some tech with you guys.
After hours.
No, I mean let's take it till the full hour, and then we can do after hours.
All right, go on. We can go here. This is actually pretty good.
Sure. Yeah.
Alejandro said that Twitter sentiment for SoFi was not hitting a new low. Honestly, the range at which he's looking at this is less than a month. But it was slowing down. Anthony Noto, are you paying attention? Yes, we are paying attention. There's a lot of buzz around this. Do you think that this means anything? Do you think that this is going to warrant a SoFi response? Do you think that they're going to address this on the next fireside chat? Thoughts? Tevis.
I think the lowest lift thing they could possibly do is to address it in the most recent fireside chat, because it's like literally in 4 days from now. I think the most effective long-term thing they could do is to have an investor day, but I'm not holding my breath for that, because we've been doing this show for long enough, man, to learn not to hold our breath for stuff. And I don't mean that in a bad way. I just mean like you should fool me once, shame on me. Fool me twice, shame on me. Fool me 3 times, shame on me. That kind of stuff.
Roy?
Baba's plan might work for a lot of people. I don't know. I think that obviously he'll say something related to that. Like communication has been an issue, and SoFi is not the only company that has this issue. It's just more of a frustration when you're holding a lot of companies that handle communication like this very, very well. And then you realize SoFi has a lot of great things going for it, a lot. And we're not just saying that and pumping it in SoFi to the moon, SoFi to 75. But the way that you communicate is just, it's leaving like that. That's one of the reasons why I said in the actual, right after we covered earnings, I was like, okay, they've left themselves very vulnerable to the shorts at this point. And I was a little bit hyperbolic and had too much of a reaction, like all-time high. Like that's not happening, especially with the strength of the loan platform. If that didn't exist, maybe. But that's so freaking strong, guys. But they really, shorts, obviously, for whatever reason, are very attracted to SoFi. It oftentimes was the largest shorted by short interest mid cap stock. And there's a lot of mid caps out there that are terrible companies that have no edge at all, that are just bleeding left and right, that are in tough environments and can't do anything about it. And they're eventually just going to go away and die. Be like, oh yeah, short should go after that. And they are a little bit, but going after SoFi is like that's weird. But SoFi already has a big target in its back. And any time that you put a little bit of blood in the water, there's just a bunch of piranhas that come after you. And that's the reality of what's happening. I don't know. I don't know how they'll address it going forward. I don't think that they'll have an investor day. I'm not confident in that at all. It'd be great if they did, as long as they had something to show off. If they have an investor day kind of like they do with their earnings calls and it's just reciting from a script, basically, don't do the investor day. That's going to actually be worse. But if they're like, hey, let's show off some things that we've been working on. Let's show off this long-term vision and show, maybe use a different metaphor than AWS of Fintech, but showcase really what SoFi's TAM is, how it will get there, what that vision looks like. If anything has shifted from when they were talking about these things pre-COVID versus now, because a lot has changed in the macro, that would be excellent. The more detail, the better. Markets hate uncertainty, and just having, well, I'm thinking of SoFi as just a two-segment business, two-platform business at this point. But because the fintech and the financial services, a tech platform, form the fintech platform now. But it would be nice to see that, even if it's not at an investor day, like in the fireside chat. If there's an opportunity, I'm sure that there would be, talk about that long-term vision, put that out there. And the 2026 guidance is great. The level of detail they've given us as far as new clients, that's really good. Like, these are nice starts, but a lot more can be done.
Yeah, I think throw up Jesse's comment, because I agree with that. Like, Noto. So Jesse commented, Noto treats this company like JP Morgan Chase. I don't see them holding investor days. And the more I think about this, and the more I think about the regulatory constraints around Noto just coming on X Spaces or on this podcast and talking about the company, is that they would always run the risk of saying things that are unscripted, number one. And then number two is they would always run the risk of potentially painting themselves in a different light to the large financial institutions. And if they're doing billions of dollars of loan platform business deals and they piss off BlackRock, or they don't come off as like super serious, or they come off like, Carp banging the table, or, doing a random.
But Carp is banging the table and he's closing multi-million-dollar deals.
My point is, because it's a regulated space, they don't really want to run the risk. Maybe that will not be a risk. Like, in reality, if in a parallel universe, if they did it, maybe it wouldn't end up being a risk. It would actually be a benefit to them and their reputation. But I'm just trying to put myself in his shoes and trying to sort of see it from his perspective, and almost coming to this conclusion that retail is like a second-class citizen, and the first, the primary stakeholder is really those institutions, because that's the bread and butter of how SoFi makes the majority of their money, through that, those lending platform deals.
And a lot of those institutions are banks.
Yeah.
Your competition.
I think we would all agree that if the choice was between, like, if you were Noto and the choice was between, let's appease retail and piss off the institutions, or let's, piss off retail and appease the institutions, he would go with the second option. I don't know if that's the case or not. I'm just trying to put myself in his shoes and be like, hey, like, why, what benefit or what risk would he weigh against each other in his mind to make that decision?
Yeah.
And there's a danger too of Noto trying to be somebody that he's not. I think he's a perfect CEO for a bank. Like, you would not want Alex Karp in charge of SoFi. Tech platform would probably be doing really well, but like, I don't know, man. You do not, like, I love Alex Karp. He's awesome. But that would be a terrible fit. And so, yeah, don't become somebody you're not. And yeah, I think Anthony Noto is good at a lot of things, but one of those things is not like freewheeling and joking around and coming up with, just thinking up off his feet and he's very prepared. You can see that, especially in a lot of the remarks that he makes. Like, you'll see where he's asked a question and somebody else ask something about that, and there will be a very, very similar way that he'll phrase something, and he's very well rehearsed, very well prepared, exudes competence, exudes control. But the downside of that is you lose some of that enthusiasm and energy, and it's kind of the way that it is. I mean, Alex Chris, another CEO I really respect and like, good fit for PayPal, but there's some drawbacks there too in his style of communication. When he's reading off a script, it doesn't work for him.
Yeah. Let's wrap there. We just did an hour. Ladies and gentlemen, thank you all so much for watching. If you want to transition over to the SoFi Weekly After Hours, it'll be posted tomorrow. You can hit the join button down below on all 3 of our channels now. Is that correct, Roy?
Yeah. I'll work with these guys to get that on my channel too. I've got a number of you guys that subscribe for some reason, so thank you for doing that. And I'll at least get you that after hours. It's always a good time.
Since we will not see you this weekend, make sure to watch the Hims commercial during the Super Bowl.
There you go.
All 3 of us are Hims shareholders, so
we all are.
We're all Hims shareholders, equally so. We
having
equally
a great
love
time this year.
company.
Thank you all so much for watching. Really do appreciate your time. Bye-bye for now.